ChargePoint stock jumped 8% today after the Federal Reserve announced it was keeping the key interest rate flat and also hinted at future rate cuts for 2024. So as you can see in ChargePoint stock today, it was right around $2.18 for most of the day, got down to about $2.15 just before the announcement, and then it just completely jumped all the way up and kept going until it got up to $2.40 per share by the time the market closed. You may be wondering why this decision by the Fed was so impactful for ChargePoint stock, and that's what I'm going to show you in today's video. This is ChargePoint's income statement from their third quarter results. This just came out a few days ago, so all of these numbers you're seeing here are pretty current. It covers the months of August, September, and October. And if you look at their total revenue, you'll notice that's at $110 million this year, which is actually lower than where it was a year prior in the third quarter of 2022. And ChargePoint actually missed their own sales expectations for this quarter by about 30%. So even the company itself was not expecting the revenues to decline this severely. But it gets even worse once you factor in the cost of revenue, which totaled $134 million this year, which was higher than the $110 million of total revenue they brought in. So ChargePoint's gross profit this year was only $24 million in the third quarter. But this number is actually worse than it looks because it includes a $42 million inventory impairment charge. In this case, ChargePoint found the real current value of their inventory to be about $42 million lower than what they were previously listing it as. Because this impairment charge was related to their inventory, it's included under their networked charging systems category, which is basically just their hardware sales business. And that's where you see this cost of revenue being $109.5 million. This includes that $42 million impairment charge. If the impairment charge was excluded from the networked charging systems cost of revenue, this number would actually be more like $67.5 million, which would give ChargePoint a gross margin on their hardware sales of about 8.7%. But unfortunately, that still doesn't cover ChargePoint's operating expenses. Those totaled almost $130 million this quarter and brought their loss from operations down to $153.8 million. If you did exclude the inventory impairment charge, that loss from operations would be more like $112 million, but that's still $112 million that ChargePoint is losing just in the third quarter alone. And if you look at ChargePoint's balance sheet, you'll see their cash is currently at $367 million, and this includes $232 million they raised from their at-the-market share offering. So without that, their cash would be significantly lower than what you're seeing right here. I would like to note, though, that ChargePoint has a $150 million revolving credit line that they still haven't drawn from, so that is another option they have available, but that's still going to increase their debt. And right now, ChargePoint already has quite a lot of debt on their balance sheet. Debt non-current is totaling $282 million, so adding another $150 million to that is not going to be the best thing for ChargePoint in the long run. Right now, ChargePoint is very strained financially, and they'll almost certainly need to raise new funds before they're able to reach profitability whenever that actually ends up happening. In my opinion, lower interest rates are probably the single most important factor when it comes to seeing a sustained recovery in ChargePoint stock. But funding isn't my only concern for ChargePoint in the long run. I'm also worried about competition, most notably from Tesla. Tesla has been expanding its charging business very quickly over the past year or so. It really started with the North American Charging Standard, which is opening up Tesla's connector design to other automakers and EV charging networks to use, and it's made the competition between Tesla and those non-Tesla charging networks much more direct. Non-Tesla EV drivers will now have access to Tesla's superchargers, as well as a lot of their level 2 destination chargers. And because of this, other EV charging networks in the US may see a hit to their utilization rates as some of those EV drivers decide to use Tesla's chargers instead. But aside from the North American Charging Standard, Tesla is also implementing payment capabilities for its level 2 hardware. This will make it a lot more viable to use Tesla's hardware for any companies operating their own EV charging business. And this has really been ChargePoint's main focus, is on these retail level 2 AC charging hardware sales. More recently, ChargePoint has also expanded into DC fast charging hardware, but this is another area that Tesla is also expanding. Tesla recently announced deals with BP and EG Group, where Tesla is going to supply those companies with their DC fast charging hardware. So we'll have to see how things continue in the charging industry now that Tesla is getting into ChargePoint's territory here. So those are my thoughts on ChargePoint right now. If you didn't see my review of their Q3 earnings, be sure to check out that video next. I'll see all of you over there, and thank you guys for watching.